There's a saying in real estate that you lose at the buy, not at the sale. For example, maybe you've heard of someone buying a used car without taking it for a test drive. Later you find out the car was in 3 accidents, the brakes don't work, and there's a family of raccoons living in the trunk. Doing proper due diligence is like having a full car inspection before you buy it, which might save you some trouble down the line. When it comes to DSTs, it's important to know how to inspect an offering before making any financial decisions. What's the first step? Well, the first step is a DST right for you? Are you okay giving up control? Are you okay with the lack of liquidity? If you're okay with those things, 9 out of 10 times a DST might work for you. In addition to that, you want to see what type of real estate is in it. Where is it located? What are the fees and the expenses? What kind of cash flow is it paying? Is the cash flow coming from the real estate? Is the cash flow coming from operating reserves? These are the first steps in evaluating a DST. What are the key financial documents that you should be reviewing? Well, ask for the appraisal, okay? Because 9 out of 10 times, the value of the DST and the property that's involved with is in what's called a private placement memorandum. And I promise you, that's 335 pages, maybe even longer. That's gonna put you to sleep. So as a real estate investor, why not get the appraisal? Why not get the rent roll? Why not get the insurance policy? These are key financial documents when looking and evaluating a DST, along with the private placement memorandum. You need to actually read all the risks and disclosures associated with making these type of investments. How long have they been doing real estate? Disregard the fact that they're brand new in the DST world, that it's really not material. Right? A DST is just a financial structure, but you want to make sure the sponsor's been around and it's been doing real estate for quite some time so that you have the confidence that they know what they're doing with your investments. Choosing asset classes, that's a big deal. Do you want just a coupon clip, sleep well at night with an investment grade tenant that's corporately guaranteeing that lease? If that's what you want, then you should be focusing on triple net lease type deals. That would be big box industrial, retail, etc. Well, if you're looking for, well, God, I want to make money on my money, well, then you should be focusing on multi-tenant type deals. That would be apartments, senior housing, student housing, self-storage, where tenants are moving in and out all the time. You know, the old tenant moves out, the new tenant moves in, paying a greater rent. Greater rent means more cash flow for the real estate. More cash flow for the real estate means the real estate is worth more money. These determining factors are going to determine whether you choose triple net leases or multi-tenant type assets in your DST. Evaluating the quality and the location of the property in a DST is really going to come from the appraisal. The appraisal is going to tell you everything you need to understand about the geographical location, population growth, household income, where's the competition. Also, you should consider it, is it in a MSA, major location? Is it a tertiary market? These things are going to determine a lot when it comes to the quality and the location of the properties that are inside any DST you choose. Here's what you should know about the financing structure of a DST. Is it all cash? What does that mean? Doesn't have a loan on it, right? Or does it have a loan? If it does have a loan, how long is the loan for? Is it 5 years, 7 years, 10 years? I can tell you, the shorter the loan, the lower the interest payment. The longer the loan, the higher the interest payment. These determining factors are going to determine how long or how short the DST is going to be held for. The role of a DST broker when it comes to your investment is so important. You don't want a broker that's just going to sell you a deal and all of a sudden the deal's sold and you don't hear from them anymore. You want a broker that is going to call you every time something is good going on, something is bad, but you're going to hear from your broker, or even not just the broker, but from the company on a quarterly basis to make sure that everything is okay with you and your investments. How do you vet a broker? There's a website. It's called FINRA Broker Check, and that is going to tell you the life history of the person that's on the phone. You'll find out if they have customer complaints, arbitrations, lawsuits, they have tax liens, and I promise you, if it looks like a Christmas tree, because you're going to see a bunch of little red dots, if it looks like a Christmas tree and it ain't Christmas, run, because that guy or that gal has a lot of problems. Evaluating the risk associated with DST just comes down to your personal experience. Are you okay with an illiquid investment or not? If liquidity is important for you, the DST is not for you because this is an illiquid investment. In addition to that, the risk associated with the DST is going to be specifically tied to the property location, the financial structure of the property, the asset type of the property. Any DST broker worth their weight in gold should help you evaluate and assist you with these decisions. So there are 3 exit strategies that you should be considering when evaluating a DST. Most common is the property is going to get sold. Mr. Investor, the property is selling. Please set up your qualified intermediary again, and you're going to start another 1031 exchange process. Another exit strategy becoming very popular, which is called a 721 exchange or an UPREIT. And I'm just going to keep it as simple as possible. Instead of you doing a 1031 exchange and giving your money to your qualified intermediary so you can do that, they hold on to your cash and they give you ownership in the operating partnership of the REIT, which allows you to continue to defer all the taxes. The benefits of that is now you're deferred amongst a lot of real estate, which is stabilizing your situation. The downside to that is that's where your 1031 exchange goes to die. We call it hospice. Another exit strategy is I don't want to do a 1031 exchange. I don't want to do a 721 exchange. Just send me my money and I'm paying my taxes. Depending on your exit strategy needs is going to determine what DST you get involved with. Remember, you want to make money on the buy, not just the sale, and you don't want to purchase a lemon from the start. Making informed investment decisions can help you as you build your portfolio. Again, these are investments that you want to look at carefully. Read the offering documents, talk to your advisor, ask a ton of questions if you don't understand something. If you have questions or you want to learn more, call 844-533-1031 or visit our website, 1031crowdfunding.com.